Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX, coming to you from the trading floor around 9 a.m. on this Friday, June the 26th. We're almost done with the month of June already. As I look back over the last month of June, I see that out of the 27 different commodities that are within our basket of commodities, our StoneX commodity tracker, 23 of them have seen losses over the past month, with only 4 of them seeing gains. So we've generally seen a shift of money flow out of the commodities, or a negative money flow toward the commodities during the past month. And that's been indicative of basic change in philosophy of the markets. We had previously seen the food and energy-based commodities seeing some pretty good strength while the war with Iran was really heating up. But now the assumption of the marketplace is that all is going to be well and that we're going to see commerce flow normally through the Strait of Hormuz, allowing the world economy to restore health once again and all to be well. That's what the markets are trading. Even this morning, we're seeing weakness across the board in most of the food and energy-based commodities, despite the fact that we saw a cargo freighter fired on by Iran's Revolutionary Guard in all appearances yesterday, and that has slowed traffic through this morning as Iran tries to reassert control of the Strait of Hormuz. Now, there's really kind of trying to poke the bear here a little bit. The Revolutionary Guard understands that President Trump really wants to see low gas prices ahead of the midterm elections. The Revolutionary Guard watched closely as the Senate narrowly missed passing a resolution that would have called on the president to withdraw troops from the region around Iran. So they see an opportunity that if they can swing the political momentum against President Trump and he would lose Congress, both houses of Congress, in November, that his power could be curtailed and that they could require him to withdraw troops, and they would come out, in their view, stronger, having stood up to the United States of America and won in their eyes. And I mean, after all, they don't care if their country gets bombed so much as long as they survive. Their method of war is kind of a guerrilla warfare type through their proxy groups. And so they just want to continue to survive for another day. And this would allow them to do that. So if all goes well and gas prices come down, that might improve President Trump's hopes of holding on to Congress in the midterm elections. However, if gas prices go back up, that could hurt them. So they're going to continue to poke the bear, in my view. And that's why I've been skeptical that we'll see a return of commerce to normal levels as the markets have been pricing in. Now, if in fact we do see a continuation of improvement of flow through the Strait of Hormuz, what are the corn and soybean markets going to be looking at going forward? There's going to be 3 primary areas of focus, in my view, going forward if everything goes well with the ceasefire. And first of all will be Tuesday's USDA quarterly stocks reports and planted acreage reports. Those reports are known for their market-moving surprises. Now, the general expectations right now is that we'll see a modest additional shift of corn acres to soybeans, nothing really market moving. And so if, in fact, we see something a much bigger shift or in one way or the direction, that would be a surprise to the markets. That could certainly influence things. If we see a big shift in stocks, unexpected move in the stocks, that could do so as well. And through the years, as I've monitored these reports over the last 40 years, I can tend to predict surprises in the direction of surprises in the monthly WASDE reports, but the quarterly stocks reports, sometimes surprises defy any type of logic. So we just have to be prepared for that possibility. Now, assuming we get through Tuesday without any real surprises, then what is the focus? At that point, it's Midwest weather. Are we going to have favorable weather or not? And you can find models that are pointing in both directions. You can find models that support a high pressure ridge setting up in the southern plains and then expanding north through the northern plains and east and then across the Midwest as summer progresses. And you can find those who say, no, El Nino is going to be the predominant factor and going to bring regular showers and moderate temperatures across the Midwest, supporting good yields. And frankly, if you look at the analog years, you look at 1997, 2015, and other years that had strong El Ninos, you find not every year with an El Nino has a good year. So you can't rule out the risk of a high pressure dome in the Midwest, but the predominant pattern is favorable weather for the Midwest. So how we get set up on these weather patterns as we turn the calendar to July, and pollination is going to be a key factor. Based on planting dates and the current forecast going forward, Commodity Weather Group is forecasting that the bulk of the corn crop is going to pollinate in the Midwest, basically between July 10 and July 30. So that 3-week period there, the last 3 weeks of July is when the bulk of the crop will pollinate. Heat can have a big negative impact on pollination then, but on the other hand, even if it's dry, if the temperatures are moderate, you can do well. These crops can do well. And so that is the default thinking right now of the marketplace. That's another reason why we're seeing pressure in the grain and oilseed markets right now. It's that seasonal factor in the absence of any obvious weather threat. What's the third thing? The third thing would be on the demand side. China has promised to buy 25 million metric tons of soybeans in the upcoming marketing year. If they're going to do that, you would expect them to start buying now. And in fact, USDA did confirm on Thursday that in the last week, and this is largely reported, that they had purchased 200,000 metric tons, about 7.3 million bushels of U.S. soybeans for delivery in the next marketing year. It starts September 1. That's the beginning. That's 200,000 tons out of 25 million metric tons promised. I'm skeptical they're going to buy 25 million metric tons. But what if they do? USDA has seemed to have factored into its balance sheet that they'll buy about 15 million metric tons in the next marketing year. Our sources on the ground in China are telling us about rumors, chatter in the cash market there, unconfirmed, that China intends to buy, this government purchases 15 million metric tons, 15 million metric tons by the end of the calendar year as a sign of good faith and intent to buy the full 25 million metric tons. And that would kind of fit with USDA's balance sheet. So that's neither bullish nor bearish. That's already basically factored into the market. Will they buy the additional 10 million metric tons? Maybe they will. I remain skeptical because once you get past the first of the year, then China's ports start to clog up with ships full of Brazilian soybeans. And so then that becomes much more of a problem to import U.S. soybeans as we get into the next calendar year. Still could do so, but it would have a dramatic impact on the market because, frankly, we don't have enough soybeans to sell them 25 million metric tons in the next marketing year because of our strong biofuel program that we have. And second of all, with Brazilian beans being cheaper, landed at the port of China, they would have to be bought by state buyers. And whatever state crushers couldn't utilize would have to go into the reserve, which we believe to be full. So they'd have to be then older beans displaced, pushed out onto the market at a price cheaper than what Brazilian beans could be in. That would cause a dramatic impact on the global market of reshuffling supplies. Brazilian basis would have to break much lower in order to attract non-China customers, the United States to Brazil, and U.S. basis go up in order to try to ration that demand and send those non-China customers to Brazil while attracting Brazilian soybeans to be imported into the U.S. Southeast. So a lot of things would happen if that were to be the case. Phase 1 trade agreement, China abided by it by about 60% level. Last fall's agreement that they'd buy 12 million metric tons in the current marketing year, they kept. So we have to respect that possibility. And of course, as I mentioned a couple of days ago, the other possibility is with Iran, where President Trump says they can have access to their frozen assets if they use those assets to purchase U.S. commodities, which they purchased 18 million metric tons of corn, soybeans, and wheat in calendar year 2025. So that's a significant potential, especially if it came on top of China living up to its commitment. And I didn't mention the $17 billion worth of non-soybean purchases that China committed to back in May as well for the next marketing year. So the potential's there for a lot of demand. I remain skeptical that we'll see all that demand, but what if we do? That would have a dramatic impact on the balance sheets. On the other hand, if we don't, then it has more of a bearish effect. That's going to be more of a long-term picture. We won't know for many months whether China, how much compliance, how much China is going to comply with what it committed to do. We won't know whether Iran's going to actually utilize those frozen funds by U.S. commodities, which we know they don't want to do, but will they do so until those ships are actually loaded, if it's going to happen? So we may not know for quite some time. Meanwhile, hostilities continue with Iran and the United States, with Iran poking the bear, as I indicated earlier. So that's kind of the focus going forward between the Strait of Hormuz, Iran poking the bear, weather problems, USDA reports, and finally what happens on the demand side of the balance sheet with Iran and with China. I'll continue to keep you updated. Be sure to like and subscribe if you want to continue to get these updates from the trading floor. Thank you.